right, we continue to have a bunch of folks joining, so why don't we kick off? I think we have all of our speakers. Hello, everyone, and welcome to the Wall Street Blockchain Alliance's Accounting, Blockchain, and Crypto Assets Ask Us Anything event. We have a wonderful group of thought leaders today, but before we start, a bit of housekeeping for today's gathering. First, this event is being recorded. In addition, this event is provided for general information purposes only. Nothing discussed at this event should be considered accounting guidance or rules proposals, nor should anything discussed be considered legal, investment, or accounting advice or opinion. All attendees will be in listen-only mode during the panel sessions themselves. We will, of course, reserve time at the end of each panel session for audience Q&A. Please submit your questions via the Zoom chat. If you would like to ask your questions directly post the panel sessions, please use the raise hand feature in Zoom during the Q&A and we will work to call on you. And now we will turn it over to Dr. Sean Stein-Smith, chair of the Wall Street Blockchain Alliance's Accounting Working Group, to kick us off. Sean, over to you.
Awesome, Ron. Thank you so much. And so I am amped for our conversation here during our first annual run. Ask us anything, right? Because obviously the whole blockchain crypto asset space has changed, evolved, and really developed in ways that in 2018, 2019, or even earlier in 2020, it's awfully hard to accurately pin down where the next big application is going to come from. But if we're talking about asset-backed coins, items like DeFi, items like that, any of the new applications, iterations that have evolved during 2020, if we're talking about privately issued asset-backed coins or coins issued now by actual governments, or the rise of prices overall in the overall crypto marketplace, or the continued trying to pin down some of the rules, guidelines, and actual frameworks for blockchain, crypto, all the rest. Either way, right, there is a need and a gap and a hunger out there for objective, quantitative conversation on the issues linked to accounting, audit, tax, for blockchain, crypto, basically how to understand it, one, how to ask the correct questions on all these issues, and then arguably most pertinent to all of us here, how to actually talk to our external clients and our internal colleagues on these issues. And so our panels here today are absolutely jam-packed with expertise, insights, boots on the ground, practical advice on these issues, linked to audit, tax, and then how to actually talk on these issues in a way that's understandable and actually helps our clients make better actual business choices. And so I was told to try to be brief, which is hard, obviously for me. And so to wrap up my own comments, I'm going to say welcome to the event, and I believe now I can toss it over to our first panel.
Okay. I am Penelope Johnson with the AICPA, and thank you so much for joining us for the Taxation of Cryptoassets panel, what to know, how to prepare, and what happens next. We have such a great panel of folks here. I'm going to let them all introduce themselves. Go ahead, Roger, if you'd like to go ahead and introduce yourself.
Hi, my name is Roger Brown. I'm head of tax and regulatory affairs for Luca. We're a software company that specializes in blockchain data and crypto assets. I myself have been an international tax financial product lawyer for about 28 years, about 10 with the US government, a national office at IRS, and then in national practices for large law firms and accounting firms as a partner.
Thank you, Roger. Brett?
Hi, I am a tax lawyer at Stewart & Kissel. Since I think 2016, we've gotten into the blockchain space and have dealt with a number of issues relating to tax and legal issues around various cryptocurrency offerings and other issues in the space. Myself, I've written a handful of articles on crypto taxation issues, and that's my background.
Thank you, Brett. Kel?
Hi, everyone. My name is Andy. I'm co-founder of a company called Verity. We do a software platform that encompasses tax accounting for professionals and individuals, as well as business accounting with integrations. And we also help with confirmation capabilities as well. My background is actually in payments and fintech reporting for over 30 years, computer science degree from Georgia Tech, and have been involved in Bitcoin since about 2012, founding member of the Bitcoin Foundation Regulatory Affairs Committee. So been around, seen quite a bit of evolution in this space.
Thank you, Kel. And Wendy.
Thank you. So my name is Wendy Walker. I'm a solution principal at Sovos. We are a software technology company that is the #1 private filer of 1099 forms in the United States. So we're been around for a long time. I personally have a background in tax compliance, tax operations in global banks. And Sovos got involved in crypto a few years ago. I personally am sort of leading that charge in our go-to-market team, and we're doing business with a lot of, exchanges and other companies dealing in digital assets that are affected by some of the tax issues we'll talk about today.
Thank you, Wendy. Okay, well, let's get started. So with crypto assets, we all know that IRS came out with guidance in 2014, and then they came out with additional guidance last year in October of 2019. The IRS has released this guidance for a virtual currency. And so what are some of the key takeaways that we should know about this latest guidance? Wendy, do you want to go ahead and get us started off?
Sure. I think that, one of the things that's very key is that the guidance is aimed at crypto investors, right? And crypto investors, I think between the Notice 2014 and the Rev Rule and the FAQs from last year understand that, very basically that they are supposed to be reporting gains and losses as a result of trading. The problem is that the notices and the guidance that's been released is very general. It speaks of the transactions in a kind of incomplete way, and certainly doesn't address all of the transactions that are occurring in the marketplace. The ecosystem is growing so fast that over the last, several months even, we've seen just growing in terms of new products that all affect tax in a different way than the FAQs and things that are contemplated in the existing guidance. So, I think as we head into 2020 season without, relevant guidance, investors need to at least, be up to snuff on sort of what's discussed in the guidance at a higher level, and, again, do their best to report. I think for payers that are, also taxpayers in this, that are anticipating guidance for withholding reporting, which is, it sort of helps these crypto investors report income taxes at the end of the year. I think they're still left with waiting for some guidance. I will say that there's been a lot of movement in the last 12 months from the IRS. We, as you mentioned, the guidance that was issued in October, but we've also seen enforcement letters being sent to crypto investors, a couple waves of those. And in the tax withholding and information reporting space, we've seen the IRS engage with the industry and try to learn more about the industry. So I think that, we can expect to see, hopefully some requirements from the IRS that are more specific to, how payers should be issuing 1099s, which will then in turn help investors and accountants and their CPAs, with processing returns.
I'll make a few other observations as well. So, Penelope, your question is great. And in short, the IRS has been issuing this guidance, which basically is informal in nature and not binding. I think that's an important point to mention, that because of the general nature of the guidance that Wendy talked about, there are many nuances and particular fact patterns, and there's been a number of comments that the breadth is overbroad. I'll touch on, for example, one aspect where they talked about taxable income on airdrop arising upon the recording of the digital asset on the blockchain. The problem there is you may not have access to the relevant token if you keep your tokens at an exchange. You have to wait for your token to be supported by the exchange. And there's litigation in California where, for example, Coinbase, probably 4 months or so after the Bitcoin Cash fork, decided to support it. And that's common for many exchanges. And if you look at it, many exchanges came on different timeframes for supporting different tokens. And that's, but again, common across different different exchanges. The issue there is an airdrop per the IRS is taxable income, ordinary income on the date of the airdrop. And any subsequent depreciation is capital in nature. Again, potentially taxed at a different rate, or if it's a loss, you can't offset your ordinary income. Because of the differences in the volatility for crypto, that can be a huge difference between your ordinary income amount taxed at close to a 40% rate, higher if you include state and local, or capital rate at 20, or not being able to even offset any capital loss against your ordinary income. So that's a huge difference. And the FAQs that IRS is basically just publishing as releases on the website, updates, I think are coming closer and more refined in their approach. But the aspect is clear in terms of the implications of when they say something on the website in this informal way, to what degree are you filing your tax return following that, where their views are actually migrating. And because in effect you have an annual snapshot, and now coming up almost on the 2020 tax filing season that will be done in 2021, you basically have to decide, do I agree with the IRS position in this informal guidance, or am I going to take a learned view, engage thoughtful advisors, and take a position that slightly differs from what the IRS may be saying, where the IRS may catch up, because the IRS is catching up what they're thinking. I think there are other areas also that are going to be attracting deeper attention. For example, the IRS believes that self-employment tax can apply to trades or businesses carried on by individuals. That's clear, that's not controversial. But then the question is, what activities can give rise to a trade or business? If you're actively staking tokens, if you're actively mining tokens, if you're participating in a decentralized protocol as a liquidity provider, are those trades or businesses? Next is crypto. Yes, crypto is a commodity. Sorry, crypto is property. That's not controversial. But what kind of property? Is it a commodity? And because there's no uniform definition of commodity, you have to take on, well, what does it mean and when can it be a commodity? And we'll come to that later on, because that's relevant to Wendy was touching on potential 1099 reporting obligations. Next is, what is fair market value? In some instances, it's very difficult to determine fair market value when the crypto trades on an exchange where there's no fiat value for the relevant crypto. So can I use some unadjusted VWAP, volume weighted average price, which in the crypto space can be unreliable given the prevalence of wash sale trading, or should I use something more reliable, for example, a method embraced by GAAP or IFRS, using a quote principal market exchange? And how do I deal with thinly traded assets? And then finally, you just touch on, there are many common transactions increasingly, particularly with PayPal supporting crypto, their announcement. Coinbase just announced they'll be issuing a debit card with crypto. So people will be increasingly using crypto for personal transactions. And that, in effect, can be shocking to people that you may be creating gain-loss events where you're using crypto that does appreciate and depreciate, where your gains on buying coffee, cars, whatever you're buying is taxable. So you're triggering tax liability when you're using crypto to buy things. And if you have a loss, then you may not be able to deduct it. And if you can't deduct it, obviously, then it's just an inefficient use. You're better off selling your crypto, claiming the loss, and then using the cash to go ahead and buy whatever you're going to buy. So I think there's those and a number of other issues that are open to be addressed in this informal guidance that the IRS is taking on. Cal, any thoughts?
A couple of thoughts. Just you and Wendy covered a lot of ground there, and I think it was all very correct and very useful. The kind of takeaways that I kind of mentioned to people in terms of the difficulty of tracking this is the immaturity of the guidance in terms of some of the terminology itself is not used correctly. They name things that are, more chain split as airdrop and other that nature. And the FAQs that you mentioned that are actually fairly helpful are non-authoritative, and you'll see questions and answers and guidance in there added and removed dynamically overnight. So it really is kind of a real-time thing. There's been comments, that are actually made, after seminars verbally. So it's really important to have either a tool vendor or yourself being able to be engaged with that and being able to track it, because it's not read it once, here's a defined list of things to do and move forward. Also, even when they do good, it can create complications. Recently, they mentioned about the virtual currency question going on the 1040 form and clarifying, well, if you didn't sell anything, then you probably don't have to check that box, right? Or words to that effect, which was slightly confusing to people. So that makes sense, and that clarifies the issue for people who just bought and held. But if they bought and held and then also engaged in staking, if you bought Algorand and you held it and you get staking rewards, then actually you should check that box. So even by trying to clarify the question due to some, deep knowledge of how some of this works, particularly the rapidly evolving worlds of staking, DeFi, CeFi with BlockFi and others that are doing great work there, they may have created some issues in trying to clarify it due to a somewhat incomplete and dynamic understanding of the space. So I think all practitioners need to be aware of that and to work with, understanding that and following it at a very trackable level and engaging with others in the community that can help as well.
Brett, did you want to add anything?
We're unmuting Brett as you speak, Penelope.
Thank you.
Yes. Can everyone hear me okay? I'm having audio issues, so I'm just moving to a better location.
Yep, we can hear you. A bit of background noise.
Okay. So, there's 2 or 3 things I'd like to add, especially on the recent development side. It's, this year I think there were 2 or 3 things that happened that I think slipped under the radar. Back in June, the IRS internally had a memo go around describing what micropayments and how they should be treated. So essentially there, it's, you'll have a small, you'll receive a token or a fraction of a token for a small task performed, and the memo was simple enough. It said, that's ordinary income and likely to be self-employment income, and that's a pretty obvious answer, but it's a good reminder that the IRS is putting it out there and kind of reminding taxpayers of these issues. Also in June, there was a PLR on, it was denying 501c3 treatment to a foundation that was managing a cryptocurrencies network. They said, it evaluated the facts of the application and it was rejected. The main reason was that the activities of managing a network are not charitable in nature. And then the final update was actually from a few weeks ago. The IRS's auditor released a report, and part of the report was on crypto audits. So it's interesting to note that there are active audits going on. Those audits are both income tax audits as well as FBAR audits. And the other thing that this report noted that I thought was very interesting is that there's not a lot of communication between the IRS and FinCEN, between the Title 26 audits for income taxes and the Title 31 audits for FBARs. And I think when you kind of think about more globally what the IRS is doing, and they're taking baby steps, yes, but this is definitely, cryptocurrency is definitely an issue and a development that's at the forefront of their radar.
Hold on, we're unmuting Penelope.
Thank you. So thank you so much for your comments on all of this. Based on the fact that this guidance or this new guidance came out last year and all of the changes that have happened this year in 2020 and the changing nature of the FAQs, right? So those are being taken off and added. What is the, I guess the IRS interaction is from that enforcement perspective. What is their policy on this? And do they have the resources to focus on this? What do you see happening in the next few years?
Yeah, that's a great. I could answer, or I could weigh in on that first. But a couple of things I would say is the IRS, they use something called the Priority Plan Guidance, the PPG, which is where they sort of outline what their priorities are for guidance for a certain fiscal year. And the crypto and the gig have come up as the emerging market priorities for at least the last 12 months. And so, at least from a resource perspective, that's supposed to mean that the IRS is focusing resources toward that issue, right? So hopefully, that's the case, at least in terms of what Brett mentioned, because there does seem to be kind of a disconnect between FinCEN and the IRS. The enforcement by education, that's sort of my terminology here with the IRS, because I mentioned the taxpayer letters that were sent out. Even if you think about the Coinbase John Doe summons, that I would say that they're really going about this the hard way. Just to take a step back, and I'm not trying to plug 1099 reporting, but understand that 1099 reporting is the primary enforcement tool that the IRS uses to enforce income tax, right? It gives them the line of sight into whether or not someone is reporting their income taxes correctly. And so without that, and without providing that guidance, to me, they're jumping around doing all of these other things, right? So they're putting a question on the 1040. What are they going to do with that information? How many taxpayers are going to send back information that they're going to sift through to figure out if there's a liability? If 1099s were issued and we had a regime in place that was, accurate, then they at least could perhaps narrow down, the needles in the haystack that they're sifting through here. So I, from my perspective, there's definitely this attitude of enforcement where quite obviously we're also along for the ride of while they're getting educated on how this actually works. The other thing I would mention too is there's a variety of use cases for crypto out there. And so Roger was talking about commodities at one point, and there are so many assets that could be argued to be commodities under 6045, which means they're already subject to the tax reporting rules and certain rules that are out there. There's some that couldn't be, that we could probably argue don't belong there. But the problem is the IRS hasn't really said, and so at this point, the guidance feels like everything is in scope and everything becomes taxable. So again, it becomes this, the other last thing I'll point out, and then I'll shut up, is that, I, as a taxpayer, we have to sign tax forms under penalties of perjury, right? And so by putting that checkbox on the 1040, by not giving taxpayers guidance that is enforceable and accurate, right, it just, to me, is setting them up for failure. So I continue to advocate for taxpayers and also my clients, which are the filers, because they do want to do this right. They do want to report. They do want to help their clients, but they definitely need the IRS to give them guidance because there's so much penalty and risk, without it.
I'll straddle some of the points that you made, as well as what Kel touched on earlier about the new form, the instructions about the box on page 1 to check. And the point is that the 1099s can, generally people are happy to get them. Who has gotten a 1099 from a broker and said, gee, I wish they didn't tell me how much gain loss I had on trading my assets? That thought has never occurred to me, because I'm very happy that somebody did the calculation for me. The problem is that those rules are broken in the current system and how they apply to exchanges because of just some inartful drafting. And that, I think in light of the Treasury Inspector General report that came out, is pretty clear that the IRS is accepting that. And by putting on the business plan a clarification, they're saying, oh yeah, you're right, I see it. Now, putting that aside, where there can be, respectful differences in whether 1099 reporting, and I would say reporting on gain loss, because I think it's different issues around reporting on, say, staking rewards or crypto interest, because those rules differ and the technical reasons when one has to do that differ. I think that when people have to affirmatively go and look to calculate their gain or loss, there's a greater degree of non-compliance, where the report that I referred to earlier, written by the Inspector General of the Treasury Department, said when you have information reporting, you generally have 98% compliance. because the taxpayer gets a copy of what they did on their return. They just give it to their accountant, or they upload it into the electronic software that they're using for tax prep, and they get they have what they have. But if you're asking them to go out and discern that, take those affirmative acts, now all of a sudden your compliance level goes down to below 50%. And in the case of crypto, where the IRS was seeing on large exchanges, per their report, 30 million accounts on one of the largest exchanges, but they only had a few hundred tax returns reporting crypto, there's this huge gap. So now when people, and maybe even some of those on the call, have to check that box that I buy, sell crypto, but they didn't report crypto in a prior year, now all of a sudden it puts into play, if some of my current positions are legacy positions and I did buy and sell, well, what did I buy and sell? Because whatever I bought and sell, depending on whether I'm using LIFO or FIFO, is going to impact what my current calculation is. And when I sign penalties of perjury, I'm signing at this time, I believe, and I'm certifying everything I did is correct. And if I learned something before, or I omitted something prior, in effect, there's an implication. So when people were using our software, and I'm sure other providers as well, they literally were not just selecting 1 year, they were selecting multiple years and correcting their crypto positions. Or they were saying self-help, okay, I didn't report that airdrop in a prior year. Let me just take a zero basis now. So when I do sell it, I'm gonna report all the income. So I'm effectively doing some self-help with regard to that. So over time, I'm paying the right amount of tax, even though in any one particular year, I may not be. And another question is, do I have to go back and file an amended return? The IRS think that's a good idea. They suggest and recommend it, but there is no legal obligation to file an amended return. And that's just a fact. You don't have a legal obligation to do that. Because when I've signed on my return to penalty of perjury, it's this year I'm doing everything correct. So you have a question around, did something I do in the prior year affect now that implicates my ability to sign under penalties of perjury? And you may decide to file an amended return, but it's not something that is legally required. It can help you from a penalty perspective, and it certainly will do that. But that's a different question if you have an understatement from penalties, as opposed to whether you are going to go for a basis reporting the right amount. It's just a different matter.
I agree with that, Roger. And one of the things, going back a little bit to one of the core question components is that it is, as Wendy said, a top enforcement priority. I think they've been hampered this year with COVID. They've got, what, 8 million pieces of mail to open. However, it is a top 3 and they are going to go forward. I think a lot of the people on this call is aware that the IRS has put out a request for contractors that have specialized software and skills to help prosecute audits for cryptocurrency and either lack of reporting or misreporting. It's my personal opinion that they're going to be going after the egregious cases where people willfully misstated or did not state. And perhaps from a practical standpoint, if someone's looking at filing and missed filing or maybe mischaracterized some filings, I'm not sure that it's up to there as an individual to decide whether they want to declare that and open up 6 years potentially of past filings on that. Whether you want to wave that red flag or not is interesting. And some of the numbers that Roger mentioned, Coinbase first half report said 35 million accounts. And more recent, it was an action during a court case. The IRS surveyed and came up with, I believe, 802 returns. And I was one of them, right? That was back in 2015. So I filed crypto taxes since 2014, actually. So when you look at the numbers, 35 million from one exchange, and just a couple of years ago, you had 802 people reporting crypto. The amount of undercompliance is huge. They're aware of that. The IRS General Counsel back in October stated that their estimates are 8% of the American public have transactions, and they're going to be coming after them. They kind of view this, and a good analogy is where the Swiss banks were not reporting, and they harvested, what, 12 to 16 billion dollars of tax revenue by going after that. I believe a similar effort, once some of the headwinds we have right now get over with, are going to be done, but they're going to be done at the egregious level and try to help people comply as they go forward. That's a personal opinion of mine.
Kel, I agree with that. It's, I think Roger and I were at an IRS symposium probably 2 weeks before the shutdown back in March. And that's exactly what the IRS said. They said, part of putting that question on Schedule 1 and now on the 1040 is just to raise awareness and to increase compliance. And you're right. I think they will go after the egregious cases, but for the average Joe trader who may have slipped up, he'll probably get a pass as long as he corrects himself and starts filing correctly going forward.
Now, Brett, I will pause because this is something that Wendy and I were sort of like twins of different gender, obviously. Is that there's one liability you think about from the perspective of the taxpayer who's doing a 1040. It's another liability for someone who has an obligation to report the information, because there is potential liability there. That's a substantive tax liability. And then number two, there's financial statement issues around that, because which they have to, which can be a material item, particularly if they have investors, they're reporting earnings, et cetera. And the degree of risk around there varies depending on what type of reporting was necessary, what the relevant item of income it was, and whether the investor was foreign or domestic. So you've got all these issues because you have different code provisions literally applying to different kinds of income, something called FDAP, ordinary income, et cetera, from one perspective versus gain loss on another perspective. And the reports, and you mentioned FBAR earlier, Brett, even the IRS and FinCEN have been, somewhat, quizzical on whether crypto has to be reported under FBAR. And they're even taking into account FATCA and what did they do there? Again, and it goes to, something that, Wendy and I are writing on how to apply crypto how to apply FATCA to crypto, because there's a number of issues that are embedded in there. And we'll come into that later. There's some overlap with what's happening at the global level. But these are all things that are driving thinking forward. And yes, the IRS will take time to write the rules because they want to get it right. It takes time to write regulations. But in the interim, we have to file and report on an annual basis.
Very interesting. Brett, did you have something to add?
I did see a question from the chat on why are there FBAR audits involving crypto, and Roger touched on it. He said, I think it was an interview or comments given by FinCEN officials to the AICPA, and certainly unofficial and non-binding, but I think the gist of those comments was that crypto accounts held offshore shouldn't be reportable on an FBAR, which raises the question of, why are these audits going on? The short answer is I don't know. I'm not privy to the subject of the audits, and I'm not aware personally of any of my clients being audited for this purpose. So I don't know, but my speculation is that maybe there were some footfalls of, if you have fiat in these offshore accounts, that could then trigger the FBAR audit. Hopefully that addresses that question.
Yeah, if it's naked crypto, I don't think you have a problem per the public statements. But as Brett said, if there's fiat in there as well, then you've got an issue, because cash clearly is a reportable item under FBAR.
Yeah.
Kel, I'm so sorry. Let me interject here real quickly and let you answer that question, but we'll be holding the other questions till the end of the panel. We've got several coming in privately as well. Go ahead, Kel, sorry.
Oh, okay. Yeah, I was going to say, actually, that's from a pure crypto standpoint, crypto doesn't have a jurisdiction, right? It's on the blockchain, which is worldwide across 10,000 nodes. So I don't know how they could ever make that point. I think if you hold any fiat, that would actually be an institutional holding at an account at a foreign jurisdiction. But if you're directly holding the private key and can control that in the blockchain, I'm not sure exactly where jurisdictionally you would be.
It's a That's a great segue, though, into kind of scope issues and things around. This is stuff that, as Roger alluded to before, we've been trying to sort of write some comments to the IRS around FATCA, and then at the global level, there has been movement by the organization, the Office of Economic and Cooperative Development, the OECD, and this is an area this is an international organization that seeks to sort of bring together, all the different tax jurisdictions, other types of issues as well. But in terms of tax, we've worked previously with them in the financial institution world to come up with what's called the Common Reporting Standard. And essentially, it's every other country's version of FATCA, right? So it's reporting of financial assets, financial transactions, financial income, that is occurring by non-U.S. institutions and by U.S. institutions, and where it's happening among participating countries. So, for example, you are a UK resident and you have an account in Germany and you're receiving income in that account. Germany, the financial institution will report to Germany, and the German government would, through a series of legal agreements, share that information with the UK government. So it's a reciprocal types of income trading agreements. At the global level, there is already a sort of a draft framework for a reporting standard that is being discussed. We've kind of gone through a couple of iterations of Q&A, and there's mostly the G20 countries are involved. All that to say, the IRS is also participating in that. They don't participate in the CRS because we have FATCA, but the point is that FATCA and CRS are generally aligned in many cases. And so as we see these other countries kind of move forward to adopt some sort of more universal, tax scheme, we're getting the opportunity to really coach them on scope and really coach them on, stable coins, certain types of exchanges, whether or not certain types of, whether something is actively traded or not for purposes of reporting. So just a variety of things that are in the existing tax law that are being, they're trying to apply to crypto transactions.
And what's interesting to Wendy, I guess, talked about the OECD, and there are key issues that they're going to address. For example, are which assets are subject to reporting, because if there's 6,000 plus digital assets, trading is most of it is in the top 20 coins. How many of those will be subject to reporting, and then who has reporting? There's a notion called a VASP, Virtual Asset Service Provider, and that is where those are the entities that have reporting obligations. So clearly a centralized exchange is a VASP and has to do reporting, where the reporting from the VASP goes to the local government, and then the local governments swap the information so that when Wendy's trading, Wendy's a bad example, she's a US citizen, but let's say Wendy in the UK is trading in Germany or China, and UK has no way to find out what Wendy's taxable income is. Well, Germany and China are going to transfer that information to the UK, so now they see what Wendy's doing from a reporting perspective. And they can align it with what Wendy reports on her return. And many countries are using our approach, what we're doing in a 1040, and requiring specific disclosures. Spain, for example, just announced that they're going to do that. They are also having to take on, well, which VASPs? Suppose you have a non-custodial wallet provider, and they don't know, for example, what the actual transfers are. They don't know if there's been a sale. They just see a movement of tokens off their platform. They don't know if it's a sale, so why should they report it? Should they report that as a disposition or not? Because they don't want to give a false number of a gain amount. And there's been discussion about going even further than traditional assets, where the VASPs, the exchanges, would report gain numbers, which obviously is the difference in fair value and basis. Well, how do I know what the basis is, where the token was transferred to my platform? I don't know what the history of the token was. It just came in. I don't know if it was an acquisition. I don't know when it was acquired and what the basis is. So you're really putting the starting point for an audit on the wrong foot, where you're putting some weights on the scale as to whatever Wendy did on her return is the wrong number. So these are the kinds of things that they're going to try to figure out. to decide whether there's a quote potential for tax evasion, because that actually is the mandate of this common reporting standard, that not whether what Wendy's taxable income actually is, but whether there's potential for her to not accurately report it. And that's where the OECD now is going. And again, even though these rules are not published yet, I don't think it's a matter of if they'll be published, if crypto will apply to them. It's a matter of when they will. And that probably is likely, a 12 to 24 month time frame. And again, the implication is not so much for if you're an exchange, you'll have exposure. I think it's now with people true in their active trading, you don't want your potential lack of compliance now spoiling what you wanted accuracy that you're going to be doing in 2 or 3 years when these rules are in effect. Because again, some legacy positions may carry over.
Yeah, I would say that move to, and actually FinCEN just recently said that perhaps they're going to lower the travel reporting to $250 for international, which is crazy. But I'm on the IMS 101 committee that did the vast travel rule guidelines and standards, and I've seen some of the things that are coming. And this is an opinion, but that kind of activity is forcing or encouraging people to move more on chain. A lot of people in the space may know that if you're trading on an exchange, you actually are not necessarily trading crypto. You're trading markers for crypto. And then at some point, if you choose to get it, receive it, or you're depositing with crypto, that's actually on chain. So natively, like I hold all of my assets on chain, not at an exchange. And I interact with other counterparties directly on the blockchain, which is fully decentralized. There's not a centralized entity for doing that reporting. And so I think there's a little blind spot there. And I think if these, needed regulations go too far, it'll be like pushing on one side and the other side coming up. So that'll be interesting to see how that happens in the future. I
would argue that's already happening. I think everyone smells regulation coming, and look at what's happened in DeFi, this whole last few months. So. DeFi, the number of active addresses, the number of other things, plus staking. If you're doing staking, you have to hold the asset yourself. Well, there's some certain exceptions, but all that has exploded, and I think it's a little bit of a direct result of clumsy regulations coming down the line. I have no problem, and most people don't have a problem with correct regulations, but some of it is clumsy. $250. I've got to file reports on sending $250 to a friend in Australia, or buying something in Australia, or wherever. It's starting to be a little overreach, and when you have that, you have reactions, and Bitcoin and blockchain are perfect avenues for fully decentralized, because that's the name, right? Decentralized. There's no centralized reporting entity on that. So it will be interesting to see how they address that going forward.
Wow, such amazing information. I've learned so much today myself. So I do want to stop now and make sure that we cover the questions from the audience. We've got some coming in. James Perillo has asked, is it the opinion of the folks here that contributing to a liquidity pool is a realization event?
Go ahead.
That's mine, no.
I would say my view is depends. So if I'm guaranteed to get my token back, the one I gave, so effectively it's a crypto loan, then I think you have a position to say, no, it's not a taxable event. On the other hand, if you could receive back a different token from the one you lent, I would say on day one, you have or get back cash, depending on the nature of the liquidity pool, then I think that would be a taxable event. So you need to, there's different vectors in DeFi. There's a liquidity pool where in effect you're contributing your token in effect to purposes of affecting other transactions, but then you'll get it back. That's fine. If there's a pool where like a BlockFi, which is a centralized model, giving them my token, they're going to do something and they can lend it out or yield whatever, but I'm always going to get that token back, or a fungible token. That's different. And I think that's, again, very defensible. But again, if I could receive something different, then that I think that is a taxable event. But I think the
Roger, what about this? Would, if you can always disclose the position as being uncertain, but do you have an argument or a reasonable basis to treat this as a common law partnership and the contributions to the liquidity pool a 721 exchange? Ignoring 721B.
I think your point is spot on. Brett's raising the point that you don't have to form a partnership, put a sign on the door saying I have a partnership in order to have a partnership, and contributions to a partnership are not taxable to the partnership or not taxable to me. And because I'm participating in a pool that is returning me a yield from the economic vicissitudes that occur inside the pool, then I have a partnership. And I think spot on, you definitely have that argument. I would say that the industry does not do that. I think you could be putting yourself in a quote trader business and then walking into self-employment tax if I do that, because partnerships are joint trades or businesses. So you have to take that into account. But these are things, and you have to deal with, well, where is that partnership? Because I could be subjecting myself to tax in other jurisdictions or other countries by virtue of that, because those are trade or business activities. So that certainly is a plausible thing that you can say. And that is a counterweight, but the IRS is going to hold you to your argument. If I say I have a partnership, and they haven't weighed in on this, but if I say I have a partnership, then you got to deal with all the consequences around that, and to the entities that are, and this goes a bit to the point we're talking about on DeFi. Well, who is a person? Does anybody in a decentralized exchange, like say Sushi Swap, have a reporting obligation? If there's no, is the broker the company that wrote the code? Because arguably they're a person, and if they write the code and throw it up there and administer it, can they absolve themselves and say no, it's peer-to-peer? Or does the IRS come back and say no, it may be peer-to-peer, but you're the one who's administering that. You're in effect the GP, and they come back at that. So your point's great, and it quite frankly just and other reasonable people believe that's a plausible argument. And you use the word reasonable, which is a really powerful word in the legal sense. I think you have a reasonable basis, but how high does that go in terms of getting you there?
Now, if I could, we have James Perillo on the call. He actually asked if he could do a follow-up call. James, you should be live and ready to talk to the panel.
Thanks. Can you hear me?
Yes.
So speaking of Sushi Swap or Uniswap, I think one of the challenges with DeFi, particularly with the liquidity pools, is that there's this liquidity pool token that is exchanged when you receive when you contribute DAI and ETH into the pool. In exchange, you get this liquidity pool token, which is a claim for some percentage, some proportionate share of the pool, whatever that pool may look like when you decide to claim. And so the question becomes, I guess, one is the liquidity pool token considered an exchange? And that's within an example where you actually have to contribute both sides of the pool, right? I think there's also stablecoin liquidity pools where you're actually able to just contribute a single token, with the thought being, hey, look, they're all stable coins. Like, you're just getting exposure to you're contributing stable coins. They're all worth $1 each. It doesn't really matter. And the question there becomes is, if the liquidity pool consists of 4 stable coins and you contribute 1 stable coin, then aren't you in essence exchanging 75% of your tokens for a claim of like a diverse set of assets? And so that's sort of the challenge we're struggling with right now, is how the liquidity pool token, particularly if it can be used and has some utility with respect to yield farming, whether that actually is an exchange of one token for another. That's sort of where I was going with it.
if you look to, there's some rulings back in the 70s around what are something called warehouse receipts on commodities. And where someone, and I think this came up around the CME, where you basically get a warehouse receipt representing an ownership interest in the underlying commodity. If moving back and forth between the commodity and the warehouse receipt is not a taxable event, it basically represents an ownership interest in the actual underlying commodity. That's a relevant point that can inform that, as long as, in effect, that your token for the protocol effectively is a warehouse receipt, almost acting like proof of your bailment, like a claim check on a coat, then you haven't disposed of it. If, however, you are not going to be guaranteed back what you, and I emphasize guaranteed as opposed to potentially I could get it back. If you're not guaranteed to get back what you put in, then there's a lot of pressure on that argument, and you may have a taxable exchange, because the statute on securities lending doesn't apply to anything other than stocks or securities, which means debt. That's just the way it was written. And then secondly, you have to rely on a provision in the statute, section 1001, which deal with, am I exchanging my ETH, my Bitcoin, for something that's materially different? And if I promise to get back what I put in, I can argue it's not a taxable disposition. But if it's a different promise that I could get back something different, even including in proportion, then I think there's a lot of pressure in the argument. And then you're going to have to be looking at Brett's argument that he put on the table, which is fair. Is I have a partnership, but that's a kettle of fish you're going to open up.
You could even talk about wrapping BTC, right?
Yeah, same thing. I mean,
same thing.
To that point, what's my asset? Is a wrapper my asset, or is the underlying asset is my asset? Because and there's a lot of case law on that you can open up, because again, it's not something you can just point to a code provision and say, aha. You literally need to go and say, well, does the wrapper represent all entitlements? So as I move between the wrapper and the underlying asset, it's a nothing, because in effect, it's just effectively a coat check, in effect, that represents the ownership of my coat.
I didn't sell it. And it could depend on the wrap, right? So, is the wrapper a centralized entity that actually, guarantees, or is it a decentralized protocol like TBTC or one of the others? So it varies a lot. At the end of the day, it's kind of an escapist thing, but I like Deloitte's way of saying, what is the thing? And you practically have to do that with the assets involved, the transaction involved, the counterparty involved. And, everyone would love to have general rules around it, but it really comes down to a lot of facts and circumstances because of the diversity and the varied nature of these transactions. You have to examine them almost one by one. So, general rules do not, necessarily apply, sad to say.
So we've got a whole bunch of questions coming in, both in the public chat here as well as privately. I want to address a private chat. Kel, I think you had mentioned staking, and we do have colleagues, several from around the world. Some of these are new terms. Could you or someone on the panel just define staking for the audience?
Well, it's a shortened term for something called proof of stake, which is an alternative consensus mechanism. Bitcoin and a lot of others use proof of work as a way of guaranteeing that everyone sees the same version of the blockchain and that consensus is achieved on a global basis. Proof of stake is something that Ethereum is moving toward, and most of the new blockchains utilize Tezos, Algorand, Celo, a couple of others. And that is where you may stake your supply or your current holdings of that coin and either delegate it, which happens a fair amount in order to get the amount of coin to be a validator. And then the network, in a decentralized fashion, gives you rewards for properly validating transactions. And there's actually effects where if you validate invalid transactions that are found later, then the rewards can go away, and also the entire amount staked can go away. So the short answer is it's a way of incentivizing people to act as blockchain node validators for newer blockchains. It has a lot of advantages, and it actually entails putting your holdings up to prove that you will validate correctly. And in return, you get rewards for it, which right now are being perceived by the IRS as a form of income. But there are some very interesting arguments of not counting them as income that a lot of people are making, including people with the Proof of Stake Alliance. So some of this could be up in the air in the future, but that's basically what staking is.
Thank you, Kel. I want to address Jor's question in the chat for the panel. How is the IRS viewing data accuracy? For example, when transferring crypto, or if using something like Uniswap, it's hard to ascertain the exact value of the coins at transaction time. One could be off by, quote, a little. Comments, please, from the panel.
You know, even in the guidance that the IRS has published, they've just sort of said, you know, reliable kind of, you know, posted mechanism. They've never really provided a good framework there. I know this is something that we've provided guidance to them about. We've asked them to, we've sort of given them some, you know, guardrails in terms of what could be, as I mentioned before, what could be considered actively traded, and then what does that mean in terms of how do you get that value. So again, right now, they're not real, at least from my perspective, they're not as clear on that topic as they could be. I think part of the issue there too, as somebody mentioned before, that, you know, the valuation of crypto changes very, very quickly. One, and depending on where you look, you know, from an, you know, arbitrage perspective, you could, you know, the value over here could be much more advantageous to you than the value over here. So we've raised those issues, and I'm, you know, but I think you just, whatever method I think is chosen, my recommendation always is stick with it, right? It needs to be a reliable method that you select and have a good defensible reason as to why you select it, but don't be changing your method. So that would be a couple things I would say.
Yeah, I think Roger will speak on this in a second, but I will say that there's pricing discrepancies everywhere. The market standard for non-institutional entities and individuals seems to be coin market cap. There are much higher standards and more difficult pricing to be done at an institutional level, determining things like principal markets and other things of that nature. And I know Luca has done some great work, so I'll hand it over to Roger to speak about that.
Thanks, Kel. You're right to refer to, well, 2 points. The FAQs from the IRS 24 through 26 provide guidance. So I would invite you to read those. Secondly, they say for a centralized or decentralized exchange, you use the price at the time of the trade. They don't tell you where to get that if, for example, there's no fiat traded. It's easy to determine price where someone gives you cash, because that's the value of it. If they give you euros or dollars, translate euro to dollars, but that's your gain loss or basis number. Next point, Kel mentioned things like CoinMarketCap. They use what they call VWAPs, volume weighted average price, which basically look to all the exchanges, gather the amount of trading, look to the pricing, get it via APIs, then they give you the price for that. The problem is with that, there's a lot of inaccuracy, as Kel referred to, and the IRS hasn't taken on what to do in that instance. We believe that you know, if you don't want discrepancy between your tax reports and your GAAP, the notion GAAP has this notion of principal market, which is basically the principal market for the relevant asset. Luca just developed a methodology that actually rates exchanges based on KYC, transparency, controls over wash sales, et cetera, to find out what the right price is if they don't have a fiat value, a currency value for that crypto, because it's traded in crypto for crypto pairs. How do you deal that? Well, you go and you use something like that, and we license that to several data distributors. If you don't have that, you'll have, and there is no exchange, and this is again from the FAQs, they do reference that you can use what they call a blockchain explorer that analyzes worldwide indices and calculates crypto value at the exact time and exact date.
Is that all?
Yeah, it's FAQ number 26. Yeah, it's awkward. be nervous about using, again, such a generalized approach. It's also contrary to what the SEC, guidance the SEC put out a few months ago around looking at executed prices. A VWAP is not an actual executed price. And then finally, for thinly traded crypto, we developed a methodology for that as well, where it takes you through a series of steps where you don't have actively traded crypto, because there's a number of those tokens where you don't have published prices, and you basically take the path to the most reliable price, because at some point that thinly traded token will trade for a more active token, and then you'll price that, and that'll give you a path. And again, happy to share more about that, but that's something that we have methodologies on as well.
Thank you, Roger. We're running short on time. We've got two last questions real quickly. One was offline. I don't know who mentioned it, but the question seems to be more of opinion. Someone had mentioned travel rule reporting of $250. Was there any logic in that decision whatsoever? I don't know the answer to that. I don't know if it was Kel or Roger who brought that up and how they came up with $250.
That's a recent proposal. We're hoping it doesn't fly. But yeah, that's the latest that they've proposed, of going down to for international. Not domestic will stay at 3,000, but 250 for international, which 250 is just crazy. You might as well report every single transaction, to FinCEN.
Kel, I think there's just a notion, and Wendy and I were seeing this at the OECD level. There's a notion that people who are dealing with crypto are doing bad things with it, and clearly, cash can be used to do bad things and has been done for centuries.
And at far greater scale.
At far greater scale. And there are some people using crypto, and actually crypto is more easily traceable than cash. But nevertheless, there seems to be a view of regulators that there's something stinky about crypto.
Wow.
I'm sorry, Wendy, go ahead.
Well, and to your point, I was going to say, that at least from the IRS perspective, I know that the notice 2014-21 came about more so because of the government sort of, uncovering criminal activity or, some kind of nefarious activity using crypto. And so as sort of a afterthought, they let the LB&I know at the IRS that there could be potentially a tax gap issue. But yeah, I think that's the whole point, is they became aware of it because of there being nefarious activities. And so it's never been able to sort of shake that bad reputation.
But I will say that I spoke at the Atlanta Federal Reserve to the Department of Justice, a special gathering they had around cryptocurrency and its use and illicit activities, and they love it. So except for Monero and Zcash, right? From that standpoint, they love the ability to trace every single transaction on the public ledger. Now they've got analytics tools from, Coinbase, Chainalysis, and others. And, I think they have IP addresses. I might be wrong, but I'm pretty sure they have all of our IP addresses around the world, right? No, I was trying to be a little sarcastic. Sorry, that didn't translate through Zoom.
But they did.
And so they love it as a tool. And I tell people the only reason that, ransomware uses Bitcoin and they keep the dollar amounts low to like 15 grand or something is that, I don't think the FBI and DHS really will, gas up and crank up the helicopter for less than, say, like $250,000. So it's just that's a marketplace almost right now. But if they care, they can trace it down to every single transaction, to every single IP address, to every person's home, and they actually love that aspect of it. With the exception of the privacy coins, Monero and Zcash, which recently in the past year added auditability capabilities, and we've actually worked with them on that. So if you're given an auditor key, you can actually prove those transactions for the many legit people. But yeah, the scale is ridiculous. If you look at German banks and others, HSBC, they're penalized. In the past couple of years, there's been penalties for money laundering and drug activity that exceed the entire market cap of crypto.
Yeah.
So there's something about, it's crypto, it's dark web, it's salacious that needs to get shaken, but we'll see.
Thank you all so much. Penelope, I think that's all the time we have for the panel. Any closing comments for your panel, Penelope?
No, thank you all so much for joining. This was so enlightening. And thank you for having me.
Thank you, everyone. Thank you, the panelists. We're going to take a brief 20-second break. We'll mute everyone and bring up our next panel. So bear with us a moment. All right, I think we have our latest panelists. I see Dr. Sean Stein-Smith, Amanda Jagruti, and our host, our panelist chair, Shoma Sina. Shoma, over to you.
Thank you, Ron. That's very distinguishing title, panel chair. Hello, everybody. My name is Shoma Sinha. I am from Plant Moran. That's an audit firm. And we have a very distinguished panel today. So I will let the members introduce themselves. Amanda, Sean, Jagruti, would you like to go ahead?
Sure, I'll kick us off. My name is Amanda Wilkie. I'm a consultant with Boomer Consulting. I focus on really technology strategy as well as process improvement, but I also focus on emerging technologies such as blockchain and how they are going to impact the public accounting profession and the industries that those firms serve. Sean?
Okay, awesome. So I'm Sean Stein-Smith, and on top of chairing the accounting working group, I do a lot of training, writing, research in the area of blockchain, crypto, sort of IT overlap. And for anyone who's online on Twitter, LinkedIn, I'm the guy constantly posting articles. So.
Hello, everyone. I'm Jagruti Solanki. I'm an audit partner at Aprio. We are a full-service CPA firm headquartered in Atlanta, and we do pretty much everything, tax, audit, valuation, SOC 1, SOC 2, and all the fun stuff. I've been in the technology space for about 13 years now, and half of that is almost blockchain. So happy to be on the panel.
Thank you all. So today we wanted to address our questions from sort of two perspectives. One is from the perspective of entities who would like to be in the blockchain space or are in the blockchain or cryptocurrency space already. And the second perspective we wanted to address is from the perspective of audit firms, because when we associate with clients who are dabbling in cryptocurrencies or in the blockchain space, it creates a lot of new issues for us that we have to manage. So the first question we have is for Amanda and Sean. And the question is, if you are an entity that is looking to enter the blockchain space, for example, to partner with other entities in a private blockchain, what should you be thinking about in terms of identifying and managing risk, and what controls, rules, etc., should you be putting in place? Amanda, do you want to go ahead?
Yeah, I'll kick us off. And I mean, there's a lot. There's a lot to consider. But I would say one of the things you want to consider is the design of the blockchain environment. So are we talking public, private, permission, permissionless? You know, if we're talking private, well, you want to consider those because you want to understand who has access to consume the data and the transactions, who has access to edit the transactions and the data in the environment. But if we're talking, you know, private here, you know, there's many configurations, but we want to understand, you know, those systems, but we also want to understand the non-blockchain type systems that are going to interact in the environment, you know, specifically those that are going to be used to reconcile and report any of the digital asset transactions off chain. I would also consider data ownership and data governance, especially in this, you know, private blockchain environment. So any controls around private key management and the infrastructure used to generate or to store private keys, or, you know, including how those private keys are going to be, you know, backed up, and are they going to be in hot wallets, cold wallets? There's a lot of risk because those keys are very important. And then third, I would say you want to consider the controls and the procedures around third parties in the environment. So are we relying on a custodian to store our digital assets? You know, we're going to want to consider the additional risks in the custodian's environment. We're going to need to understand, if we're commingling assets or that third party is commingling assets among consumers, are they maintaining things off ledger? All of those really will introduce risk into the environment. And we're going to need to drill down and peel back some of those layers to identify and mitigate those risks appropriately. I would also say you're going to want to look at the third parties' procedures, their controls, their audit reports. So I would recommend calling a really good auditor. And if you need one of those, I know a couple. They're on these calls. So Sean, what would you add to that?
Yeah, and I mean, probably the sort of opening bid in any conversation, right, for any entity trying to either join a private blockchain being organized elsewhere or even building one in-house, is to actually understand sort of how actually onboarding a in-house blockchain or even joining a external one will actually impact the controls and the workflows, right, at the entity, right? Because all of us here are in this sort of crypto blockchain bubble, right? We're always, in it, talking about it, working on these issues. But out there in the sort of non-expert area, there is really still this idea that as a blockchain-based or blockchain-augmented platform enters into the marketplace or into the firm, there really is going to be a sort of loss of interest in the actual controls on the information, on the workflows at the entity and at its actual supply chain partners. And actually, as we all know, right, the idea of blockchain or a in-house blockchain, private blockchain, public blockchain, all the rest are not evolving on their own, right? They are being onboarded with automation on top of existing IT platforms. And as these new applications and tools are brought into firms and are brought into sort of broader networks, there honestly has to be a well thought out conversation on how these new blockchain-based tools, automation, all the rest, are going to change how the controls at the entity and at any entity's part of the network have to evolve and actually be updated, right? And there also has to be a process to try to echo your earlier points on actually who has access to the actual blockchain itself, right? Both the coding language and any transactional data stored on that blockchain, right? Because there are any number of firms out there who are experts in the IT side of things, right? On the coding, the building out of the blockchain proper. But are there folks on their staff who are experts in healthcare, transportation, food safety, IP areas? And so it's always critical, I think, to one, have a understanding on the IT side of things, but to also have a conversation and to really understand how the blockchain will interact with current IT platforms and other issues that are going to pop up from area to area, right? Be it health and transportation data, credit card data, other types of data and content that are always going to be different from the firm. And then to sort of add on, right, one other point here. Is there a plan in place at the firm if there's a change in ownership, if there's a change in the top management at the firm? Is there a plan in place to help ensure that as the firm evolves and changes, grows, expands, is bought or is actually buying other firms out there, as the folks at the firm change, are there processes in place that have been updated to contend with key access, wallet access to that coding language on the blockchain, right? So I would say ultimately that the whole conversation on actually joining a blockchain, building out a blockchain, is honestly only one one part of it is on the IT side proper, right? The actual coding of the blockchain, and the big bulk of the conversation is on IT issues, access issues, and honestly more a conversation on how the blockchain works with the business.
Governance issues too, right? Sean, I mean, you can have coders, you can have IT specialists, but an important thing is who sets the tone and who sets those policies and are in charge of setting those policies, updating them, etc.
Yeah, and to sort of add on to that, right? In terms of that tone of the top, right? Tone at the top always matters, is always going to be a huge deal for any big time project at any entity. But there's also the whole issue on how to train staff, right? On how to have them be educated, informed, and actually on board, right? Because the tone at the top can always be positive, but if the employees who are tasked to actually use the blockchain platform aren't motivated, are not interested in doing so, it isn't ever going to operate as advertised.
Yeah.
Yeah. And I would just kind of echo what Sean is saying. I think that to really make these projects successful, it has to be a collaborative effort. It has to, you have to have people from the compliance areas. You have to have people from technology. You have to have people from the entire business, and bring them all together to truly make these projects successful.
And also bring in outside experts. Amanda, I think you made that point when
Yep.
you were speaking before. So start from a point of humility, I guess, and recognize things that we do not know, and bring in the experts. Thank you both. We'll stay with you, Sean. And the question for you is, how would you, as a participant in the blockchain space, navigate the world of laws and regulations? So, and if you can provide some examples of laws that apply to specific industries. So Sean, go ahead, and Amanda, if you want to add after Sean.
Yeah, sure thing. So probably the first item I would do is I would call some experts, right? Obviously, always call experts in the industry that you are actually analyzing, right? Because every industry is different, and there are always nuances and other items in there that all of us, as informed and as expert as we are, can't know everything on every single firm or every single area, right? But in terms of sort of how to get blockchain up and running, in terms of how to advise clients that you do so, it is awfully important, I think, to always understand, right, that the whole idea of blockchain at a very basic level for a external client conversation is to actually gain some of those operational efficiencies in terms of how data is stored and transferred between the members of this network, right? It can be public, it can be private, it can be here, overseas, or it can be based in crypto tokens or not. But the whole idea is to help gain some of those data transfer, data export, data efficiencies. But it's important to also note that actually not every type of data is able to be transferred as easily or as transparently as others. Now, obviously, in the banking area, there's KYC, AML, knowing your customer, anti-money laundering laws, and all of that. But there are always going to be oversight rules for industries, like healthcare has HIPAA, and as you're doing business overseas and even in a nation, right, there are different rules that are going to govern how the data and how the information of individuals are treated, stored, and then who has access to it. Over in the EU, right, there was the passage of the GDPR, which was probably the biggest deal from a headline point of view. But there are always going to be sort of variations in terms of actually who owns the information. I was just talking to a firm just during the past week that's an online content platform, basically, that has users upload content onto their platform and they have it monetized, all the rest. But a ongoing question is actually who owns that that content, and who has the right to edit it, tweak it, modify it, take it down, all the rest. And so it's really important, I would say, even more so going forward, that as you're talking to clients in really any industry, but any industry that has to do with any IP, intellectual property, or individual content being created and uploaded, that the guidelines and the rules as to who owns what data, and then actually who has the right to transfer, edit, or to post up that that data is outlined up front.
Yeah, Sean, I would.
You okay, man?
Let's see.
Okay.
Let's try that one more time.
And take two.
Yeah, a little frog in my throat. I was going to say, Sean, I would definitely echo what you're saying around consumer privacy and any type of data portability. I mean, identity is one of my favorite use cases for blockchain. So things like GDPR, the CCPA, the California Consumer Protection Act, we're going to see more and more of those throughout the U.S. So I think those are definitely some areas to pay attention to. And like you said, just about every industry has some sort of laws or regulations that can and will be impacted by blockchain. But that also gives us the opportunity to support those laws and those regulations with the transparency that blockchain gives us. One place that I think we can easily see this opportunity, and we're hearing a lot about it, is in agriculture. It's a global industry, and in agriculture, blockchain has the potential to help support food safety regulations. It can result in, better data for recalls, greater confidence in the supply chain. And there are dozens of organic certifications for food worldwide, and those foods are believed to be higher, nutritional value because we're not using pesticides and all of those things. So they're able to be sold at a premium, and anything that can be sold at a premium just opens the opportunity for fraud. So blockchain can help digitally trace and authenticate food. It can help protect the suppliers. It increases the transparency. It can help enforce the standards. So again, I do think that every industry has an opportunity to take advantage of that transparency that is just inherent in blockchain. I will say that there's one possible law that I'm looking at, or regulation that I'm looking at, I'm keeping an eye on. It's HR 8525. So this was referred to the House Committee on Energy and Commerce by the Blockchain Caucus, and this bill would actually amend the electronic signatures. I think it's the Electronic Signature Global National Commerce Act or something to that effect, so don't quote me on that, but it would amend that to where we could actually recognize digital signatures on blockchain as enforceable by law. So electronic signatures, smart contracts that are created, stored, secured on blockchain, those would be recognized as as enforceable by law. Additionally, it would encourage uniform standards around the validity and the enforceability of these transactions and these signatures. So I think that's one that I am definitely keeping an eye on and would recommend that we all do so. Joe?
Meta, is there a problem with enforceability of smart contracts now?
Well, I think it can be argued. I mean, I think that having a having a law that actually gives us the legal effect and gives us the validity behind it, it just allows us to be more enforceable. It'll be, I don't want to say it'll be more cut and dry, because nothing is really cut and dry, but I think we could argue it a bit better.
And I'll add something to just talking about smart contracts, right? I mean, end of the day, if I think about smart contracts, it's just bunch of codes, right? It's just bunch of codes that a programmer put together, or to kind of automate a certain business logic, right? So end of the day, it could be just nothing but a pure automation process to automate a process that is, that just needs to happen on an ongoing basis. I think the biggest, I wouldn't say issue, but I think one of the concerns in just using smart contracts or making them enforceable is to first make sure, is that smart contract or is that set of codes doing what it's supposed to do? Does it agree with your business logic? Is it consistent with the process and the standards that it's supposed to meet? Does it meet all the criteria that that's kind of authorized and approved? Because I mean, end of the day, once that smart contract is executed, it just kicks out an output and it's done. It's recorded on that blockchain. And once something is on blockchain, you can't necessarily delete that transaction or entry. So I think, one of the challenges with making a smart contract enforceable, again, I'm not talking from legal side, but more from just data accuracy standpoint is a whole lot of diligence that would need to be done on that particular smart contract before even kind of going down the path of, is this enforceable?
Yeah, and that's a really good point, Dhruti. A smart contract really is just code. It's an application. So it's not really smart, nor is it a contract, but it executes something that may need to be enforceable.
Okay. All right, so we're going to shift gear and go to a question to our auditor on the panel, Dhruti, and then Amanda, if you can chime in. So our question is that as an auditor or an audit firm, what are the different ways that our clients interact with this technology or cryptocurrencies that raise more or different risks for your firms, and how would you address those risks during client acceptance?
Sure. So for, I don't know how many CPAs or audit firms are on the audience here, but one of the biggest challenges in accepting any crypto client or pretty much any client, you have to go through a typical client acceptance process. Now, client acceptance process is not different for any crypto client. It's the same standard, whatever criteria guidance you need to follow, like your independence rule, you got to look at auditor skill set, you got to look at management integrity, process and controls. You pretty much have to go through the same things that you would do for any non-blockchain or non-crypto clients. I think the biggest difference is where there's just a lot more diligence, upfront diligence needed to onboard or to kind of get through client acceptance for a crypto client that you would not necessarily need to do for any other technology client. And then the reason being, the whole blockchain and crypto space is, I wouldn't say it's new, but it is still kind of considering other existing technologies. It's still new, it's still changing. Stuff that we know 2 months back is probably old, outdated, and something else has evolved and changed by now. Lately we hear a lot about DeFi and decentralized finance, crypto lending, and that's kind of the next best thing happening in the space. So it's changing so fast that it requires us as auditors to be a little more diligent upfront before onboarding a client and ask the right questions. Like, for example, just kind of talking about auditor skill set, right? That's one of the requirements that client acceptance is going to look at internally. Like, do we have the right team to audit a crypto client? Did our audit team get the appropriate amount of training needed to audit blockchain and crypto assets? Are we familiar in the space? Is there a blockchain or digital asset SME in the department? Outside of the skill set of just the financial auditors, I think with crypto companies, the role of an IT auditor becomes even more important. Many times, when we do financial statement audits, we tend to, depending again on the type of client, it may be okay to not rely on IT controls and not reduce your substantive procedures and just test, a lot. But now with crypto companies, since so much of the testing goes back to, what's happening in the underlying blockchain infrastructure, or how's the consensus mechanism, what's happening in the platform itself. A lot of these data could be your source for your accounting journal entries. So end of the day, it's the importance of an IT auditor, getting them comfortable on the IT controls over the platform and that infrastructure, and working hand in hand with the financial auditor. That I think becomes very important. In fact, as an auditor, like I'm a financial statement auditor, I don't do SOC 1, I don't do SOC 2, but I work with our partners who do SOC 1 and SOC 2. They are involved very heavily in our audit acceptance process, kind of making sure we as a firm are comfortable taking on the risk of auditing a client, knowing what controls they have on their blockchain platform. So I think that a lot of, I would say, audit pre-diligence is kind of now part of the acceptance process. The other thing to consider, which is slightly different, just a little more detailed, I would say, is kind of asking the right questions to management, which you would probably not think about if it's a normal technology company. A lot of crypto companies, they may be required to go through KYC process. They may have money transmitter licenses that they need to file, anti-money laundering requirements that they need to comply with. Given that there is really no concrete legal framework around any of this just yet, there's more onus on us to ask those right questions and make sure, company, to the best of their efforts, they are complying with all these requirements that you would need to follow. One other question could be, are they working with a legal counsel before they do any kind of crypto transaction, just to make sure it's within the legal boundaries. And even kind of take that one step further to make sure they are working with a legal counsel who is a blockchain expert, who knows the space and who is not, who kind of has done it before. So looking at qualifications of service providers and kind of taking that one step further, I think those kind of greater level of diligence is what we are seeing in our client acceptance process.
And I would add to that, one thing that an audit firm would want to really look at or talk to the client about is, are they going to invest or in an ICO, or do they plan on doing an ICO? Because to Jagruti's point, you're going to want to make sure that your team understands the implications of ICOs. So, what's the client's process for selecting how to invest and determining, whether or not that asset is actually a security? How is management are they relying on experts for that information? Or what exactly is the business rationale and the due diligence process around ICOs and their willingness to invest? Go ahead, Jagruti.
Yeah, ICOs, STOs, then the follow-up question will be, are they filing with the SEC? Are they following, Reg A, Reg A plus, whatever, the requirements are, and are they kind of meeting those requirements and filing appropriately? So yeah, I mean, it's a lot of those early on diligence questions that kind of, and a lot of this, what I tell our clients is, it's heavy lifting work before we accept you as a client. But all of this kind of helps us with our risk assessment, which is kind of, one of the initial steps that we do as auditors. It just kind of makes the latter part of the process much easier.
Yeah, absolutely. And it is unique to these types of clients. It's things that we haven't had to ask in the past. And as we've established here today, it's things that are changing rapidly. We used to just have ICO. Now we have, like Jagruti said, ICO, STO. I'm sure there's a few other O's out there.
IEOs.
Yeah, LMNOPs, all of those things. So there's, it's a rapidly changing space, and it's a lot to really keep up with. Shomi, you asked about how to really address some of these risks, and I would say one of the things that we can do is continuing education. That's one way to really mitigate the risk. You know, our audit teams today, our audit teams, our firm management, IT, everyone involved, you know, they have to keep up with the changes in blockchain regulation. Again, that's a space that we've established today is changing and is constantly in a state of flux right now. They have to keep up with the industries which they serve and how blockchain is impacting those industries and the regulations and laws in those areas. But they have to keep up with the technology as well. And again, it is evolving very, very quickly. So we need to identify within our accounting firms, we need to identify and cultivate a passion for blockchain. Well, not only within our firms, but within the organizations that we serve. So, and again, we've already established this, it needs to be collaborative. I'm a technologist within the public accounting profession. I'm not a CPA, but I'm here with CPAs. You know, I'm here with an educator. I'm here with practitioners. And these are the thought leaders in the space that I follow and I look to for guidance. And I appreciate the WSBA bringing us together because I think collectively, you know, we have a lot to share and a lot of information. And I'll also say that, you know, the WSBA and the AICPA, that partnership is a great example of organizations that are collaborating to do the best they can to prepare the profession for the impact of blockchain. And I just think that we need to ensure that those resources are known about, they're available, and they're leveraged, you know, by everyone within our firms and our organizations.
Yeah, again, you know, start from a position of humility and bring the experts in. The word that kept coming to my mind is being nimble, you know, and agile. And those are some of the things that we auditors are not known for, because our audit standards have probably remained static for what, like, you know, almost 100 years, maybe.
Centuries, right?
Yeah, but now things are changing so rapidly and changing in areas where we are not comfortable, in IT areas, you know, technology areas, and just kind of keeping up with all that. And plus, you know, I am looking at the issues that my audit firm is facing, and we are getting very close to the start of a busy season, another busy season, and we have issues related to COVID-19. So it's not just you know, the blockchain or technology issues and things like that, but like collapsing of our known environment all around us, which is so challenging to deal with. Sean, question for you. So stable coins and other asset-backed coins are gaining popularity. As an auditor, what would you consider are some specific audit risks related to this kind of cryptocurrency, if you can speak to that?
Yeah. So the whole asset-backed coin conversation, whether it's a privately issued stablecoin, whether it's a CBDC or it's a tokenized building, right? This whole idea of trying to build a hybrid or an on-ramp almost, right, for the non-expert individual, entrepreneur, institution to actually enter into crypto transactions and to get more comfortable with blockchain and crypto has honestly been, I would say personally, the high growth area of crypto. I would say really since 2018 and all the way through into 2020. But as far as the audit side goes on these coins, right, adding in that fiat underlying asset or that commodity asset underneath the overlay of crypto is on one hand good, right? Because it adds that peg, adds that tethering, and on paper helps sort of tamp down some price volatility. But in order to operate as advertised and to have the confidence of the marketplace, right, we have to have that transparency and that access both on the sort of exterior crypto side and then also the underlying asset, right? So if we have a coin or a token backed on a one-to-one basis by the US dollar, where are those dollars held? Are they held at a institution that's covered by FDIC insurance? And then are those books open actually to be audited, right? All of these questions might seem pretty basic, but in the hype and the sort of froth of this whole asset-backed coin, asset-backed token area, it's often easy to overlook some of these more basic questions, right? Sort of, okay, fine. Firm A issues a coin or a token or is trying to tokenize a building or some land, and it's backed or underpinned or tethered to this external asset. Great, but is this actually operating as advertised, right? Is that peg, is that underlying support actually holding true, right? Because I can issue a coin or a token and say, okay, fine, it's the SSS coin pegged on a one-to-one basis to the US dollar. But how do I prove that peg is actually holding and that external consumers, external businesses are actually valuing my coin or token at that basis, right? And sort of how do we audit that? How do we get that transparency into one, is that peg holding? And then two, how much is holding that peg actually costing us, right? So a good sort of parallel that I've used is that sort of holding that peg for any asset-backed coin or token is almost like a foreign currency being artificially pegged, right, to the US dollar. Doing so costs money, and it does have to be shown on the income statement, on the balance sheet, and it has to be there. And it has to be there in a manner that is actually transparent and able to be understood by external market users. And then ultimately, who is holding these actual assets, right? Who has custody of the underlying assets? Are they here in the US? Are they overseas? And then do those different areas have sort of varying rules as to how those underlying assets have to be treated? And so really, from a audit point of view, it honestly can be boiled down to, are the coins or tokens operating as advertised? Do the underlying assets actually exist? And are the coins external valuation actually being shown correctly on the books of the issuing firm and the firms that are taking them to actually do transactions?
Thank you, Sean. Final question to you, Jagruti. What are some of the accounting challenges that auditors should consider?
Yeah, so there's quite a few. There are a couple that a lot of the crypto companies have, this commonly asked question, right? Like it kind of boils down to, how do you treat digital assets on your balance sheet, right? Is it digital assets or crypto assets? Like how are they reflected on balance sheet? Is it cash equivalent? Is it, foreign currency type? Is it an intangible asset? Or do we fair value these assets? Like that is one of the burning questions that pretty much every company has. Now, before I kind of get into that, one of the things I want to point out is there's really no accounting standard as of now. There's no authoritative guidance. There is no, there's nothing concrete out there that we can kind of refer back to. So what most companies are doing is kind of using existing guidance and kind of using that as a reference to use that as an analogy to client's example and see what's the best case scenario given what's already in standards. Now I know AICPA we have a digital asset task force for accounting and audit, and AICPA has issued a practice aid in December of last year. That was the first practice aid when it came out, and we are kind of building on top of that, where we are addressing a commonly asked accounting questions and also audit considerations. So by all means, refer to that practice aid. It's a very intense, very detailed laid out practice aid. So back on the treatment of digital assets, right? Like after you go through the standard checklist, so to speak, for how could an asset be classified? Like, is it cash equivalent, foreign financial instrument, etc.? We kind of really boil down to two things. It's a kind of a lot of CPA firms have taken a general position that If you're not a broker dealer, most likely your crypto asset is going to be treated as an intangible asset on your balance sheet. Now, what that means from an accounting standpoint is that you record your crypto asset at cost basis, and you don't ever fair value, you don't ever mark it up if the value increases. But if the value decreases, and if the decrease is permanent in nature, then you pretty much have something called an impairment expense that you got to record on your income statement as an expense. Now, it sounds pretty easy, but where it gets challenging is getting the data to calculate what your basis is for these crypto assets, calculating what your realized gains or losses should be, calculating or estimating what your impairment expense should be. That's where it gets very challenging, especially if companies have a large volume of crypto transactions that they are dealing with, and it's not just one crypto asset, it's multiple. We have seen a lot of our clients use softwares like Kel at Verity. That's a great software. Clients using that software to track, aggregate all their crypto transactions from wallets, exchanges into that one software, and be able to estimate your gains and losses and basis using software like that. There are a few clients who we have seen using just good old Excel, and Excel is awesome, but it can just do so much. And for an auditor, one of the concerns is, relying on these external softwares, right? And then this kind of goes back on, if as an auditor, you end up relying on an external software, then you got to do more than just using a software that, that just kind of gives the company what they need. One of the things as auditors we look at is, does the external party that company is using, do they have a SOC 1 or a SOC 2? Now, SOC 1 is a compliance certification that really helps a service, that really helps prove whether the service organization has proper controls when it comes to financial statement reporting requirements. Mostly CPAs would want a SOC 1 type 2 report. Type 2 is where you kind of look at controls, or you test controls over a period of time versus at a point in time. So as an auditor, it's not uncommon to ask for SOC 1 reports for your service organizations if the company is using a third-party software to, say, track crypto assets. Now, if they do not have a SOC 1 or SOC 2, SOC 1 mostly is what we would need, then there are other alternative procedures that auditors would need to consider, which again increases the testing volume and the way we test transactions. So that's kind of one of the things that when you think about accounting considerations, like how do you treat digital assets on books, you also kind of have to think about what audit trail to keep as you are tracking crypto assets the way you're tracking. The other approach is fair value, where you're just fair valuing mark to market all your crypto assets. The change in the fair value is pretty much unrealized gains or losses. Again, the concerns there, very similar. You still got to track your cost basis, but now you also got to track your fair market value on a periodic basis and adjust your balance sheet accordingly. Those are some of the things from treatment of asset standpoint. The other accounting question we get a lot is valuation. Sean, you were talking about valuation concerns earlier. If it's a thinly traded asset, thinly traded crypto asset, you don't find that on more than like 2 or 3 exchanges that are not as popular as Coinbase, for example. Maybe it doesn't have an active market. The question then becomes, how do you value those assets, right? You get a third-party valuation, or you use certain tools that can tell what the valuation is. But then again, you have to use significant judgment to consider whether there needs to be a significant discount because of lack of liquidity to that token or of that crypto asset, right? Those are some of the accounting challenges, which then again kind of raises similar concerns from an audit direction, and changing procedures to audit something on those lines.
Jagruti, you mentioned the AICPA practice aid, and I think that it was actually updated recently and re-released. So if you have looked at it previously, if anyone on the call has looked at it previously, I would recommend going back and reviewing it.
Yeah, it's a append only. I think there were 3 releases. There was one in December, one early this year, and one just this month. So it's the same link. You just have to keep refreshing. I mean, you just have to clear your cookies and refresh, as you see the same old document.
Jagriti and we also, Jagriti and Amanda, we also share the updated link every week on the newsletter as well, because we realize that they're doing append only.
Perfect.
Great.
Okay. Thank you very much for everyone on the panel. Ron, are you ready with questions?
I've received a boatload of questions offline as well as several in the chat. Let's kick off with an offline question. I think, Amanda, this might cross your radar first. And one of the questions, and I think it was you or Sean had mentioned, there really needs to be an understanding of the IT side. A lot of the feedback we get from members that are in the accounting profession is, well, I'm not in IT. So the question really becomes, how have you been bridging that gap, and what's kind of that advice for the accounting professional going forward?
Yeah, well, I would say, I'm not a CPA, but I get my taxes done every year. So again, it goes back to that collaboration and finding those people that you can connect with. And, like Shoma has said a couple times, you got to chuck your ego to the side, because we're all learning this together. So I have dug in a lot, just researching the technical side. I have not been technical for a long time. I feel like I can, I feel like code is like learning a second language. I can translate it. I can read it, but I really can't speak it or write it. But I feel like I've got enough that, if Sean or Jagriti or someone called me and wanted to discuss it, we could dive in and figure it out together. So I would, again, say, finding those people that share your passion, that's going to help you bridge that gap.
Yeah.
Great. Go ahead, Sean. I'm sorry.
No, yeah, and to just sort of just add on to that, the only thing that I would say is that all of us are not IT people, right? Are not coders, are not programmers. A whole field of those folks already are out there, but all of us have to have the correct level of knowledge on blockchain, on crypto, to be able to ask the correct questions, and to also then understand the answers given to us, right? To make sure that they make good business actual sense.
Right. I'll add very quickly to that. I am a financial auditor. I'm not an IT person either, but I have gotten into sort of the technology space in various ways, and I have also worked with IT people within my firm to kind of teach them how to speak to auditors, because there can be a gap on that side as well. So it's kind of, two different groups, two different competencies kind of speaking to each other, and there has to be understanding of the issues on both sides and not just on the financial auditor side. So it's kind of raising both those groups at the same time.
I know we're about to lose Jagriti for a hard stop, but Jagriti, if you had any closing comments before you headed out, and then we'll hit some additional questions.
No, I mean, I think I'll probably stay on until 4 o'clock. But yeah, I mean, Shoma, as you said, I think completely agree with you. One of the things, I'm a financial side too, right? But working very closely with our IT auditor, and sometimes there could be disconnect in what they are thinking and what we are thinking, and, kind of converting that and laying out the fundamentals, that does help a lot. One of the things that, we have noticed that helps a lot is making sure the IT auditors is involved in the initial planning process. Like when you're kind of understanding the company, what is the company doing? What's their business? What consensus mechanism are they using? How's their infrastructure, right? Like all those basic understanding the company type of questions. It's really a team of 2 or 3 who are kind of listening to it and asking questions both ways. So have learned a lot by just listening to our guys kind of ask the questions. And I think that's kind of important to just have your team together during initial stages.
Great. Thank you, Jagriti. Thank you, everyone. I do want to hit some of the chat questions. Dan Simpson had an early question, which was really interesting because we've encountered this before. Could you achieve the same goal using a more traditional database system? This goes right back to the why blockchain. Is that still a conversation in the accounting and audit space? And how have you all been approaching that?
I would say so, yes. I mean, there is this underlying fact, right? That not every business nor every problem at a business is able to be solved with a blockchain-based platform, right? Just full stop. Not every problem or every firm is either up to that task, has the budget, personnel, or really has the problems that are able to be fixed with blockchain, right? And really, in any conversation I have, that's the first question that I ask, right? Why blockchain or why a ICO, STO, IEO, right? So why are you doing this? Is it actually linked to the business? Is there a problem at the business level or a process level, or is it a real IT problem? And so then answering that question is, I would say, really the opening bid, right, for any conversation on if a company should be a part of a blockchain, do a ICO, STO, IEO, ABC, or other items like that.
And sometimes the answer to why blockchain may be because we're doing research, we're looking at innovation. So it might not be the best a platform for it, but like you said, what's the business getting out of it? What's the business purpose out of it?
And I'll add to that. One of the things that similar question, like why blockchain, right? And one of the things that I'm also seeing is that where blockchain need not kind of be a solution that overhauls or rips off your existing system, right? You might continue using 50 different ERP systems all across all your entities, but maybe all those systems are disintegrated and they don't talk to each other, and now you need a solution that kind of connects all these different systems. And maybe blockchain is a solution for just kind of that integrator or that connector. It need not be thought of as, blockchain is replacing what you already have in place. It's maybe just adding, connecting dots.
Great, thank you. A couple more questions. Bibi Rubio has a really interesting question, and I know the AICPA has published a lot of stuff, but education around certifications, you've all been through either teaching courses or reviewing courses. Any open advice for the group here, or any suggestions?
Go ahead, John.
I would say personally, because I've been
wow.
Yeah. Thanks for that, Amanda. I would say personally that the whole suite of courses put out by the ICPA for healthcare, for FAs, for auditors are great, comprehensive courses, and really, I mean, they do a excellent job at introducing topics, giving some background and context, and then also they are constantly being updated and tweaked. I mean, so I would say that really that's the best place to start getting a education background and then also some current context.
Thank you. You've also all raised kind of having the conversations with potential clients when they're doing an STO or some type of token offering, getting involved in the token space. One of the challenges in the marketplace is understanding the impact of custody of tokens. How deeply is the accounting profession involved in understanding the custodianship of these tokens, and kind of what are the important takeaways in that conversation for clients? That was an offline question, by the way.
I would say personally that it's honestly more of an issue for the asset-backed coin space. I know just me personally, in the conversation I've had, that the bulk of companies that are taking crypto as payments are doing so more to do some research, try to offer that as a sort of headline news story, as opposed to really having it be a core component of their business. I would say that it's an issue, that it's a topic that really, I think that we in the field, right, be it audit, tax, advisory, all the rest, do have to get our hands more around, right, as to sort of how these coins are held, who is holding them, access over them, because as more and more types of asset-backed coins and tokens enter the marketplace, that is, I would say, going to become equally as important as having clients manage their private keys correctly.
What Sean said.
What? One last comment. I think it alludes to some. I think this might be the last question. I know Jagruti had a hop and several others. We had an offline comment, and it goes back to auditing. And there's always this conversation. Actually, Amanda, you and I chatted about this quite a while ago. When you hear the audit professionals say, "Well, blockchain's trying to make the audit go away," our response is that's absolutely not true, but it evolves the audit, and there'll be a much more important focus on the qualitative aspects. Is that clearer now for this space, for the industry, what those qualitative aspects are over time versus the quote unquote pure quantitative aspects?
Yeah, I think it's becoming more and more clear because more and more firms are getting into this space. You know, the audit changed when, you know, when we introduced technology, when the computer, you know, was introduced, and blockchain is going to evolve it as well. But to your point, it will be more qualitative, but also it'll focus more on the internal controls and how the data actually gets into the system, because we're going to be able to trust the data that's coming out of those systems much more. So it just changes the focus, which is something that audit firms really need to be looking at, because it is going to change the skill set that you need a bit more.
Great, thank you. We're just about out of time. Shoma or Sean, any open comments from you?
I just wanted to add on to something that Amanda, you said. I kind of agree and disagree with you. You said that we have to do things differently, but you know, looking at internal controls and how data gets into the system, we should have been looking at it when ERP systems came into being. So it's not, you know, I know we are applying this in a different format, in a different framework, but not really new concepts so far. And a lot of the times we just don't know what to do because we have not elevated our game in terms of being, you know, understanding technology as well as, you know, financial aspects and things like that.
I would agree with that, Shoma. I mean, the firms that have been doing that, they're ahead of the game.
Yep,
and
exactly.
the ones that haven't, they need to start doing it or they're going to be irrelevant.
Yep.
Well, we are at 4 o'clock. Thank you all so much. Thank you, Shoma, for moderating. Thank you to all of our panelists. We couldn't get to all of the questions. Please email us, info@wsba.co. We'd be happy to get those in front of our panelists. You are all the best. Thanks for joining us. The recording should be available sometime in the next several days. And be well, everyone. Until next time.
Awesome.
Thank
Bye-bye.
you. Bye,
Thanks,
everyone.
everybody.